Hello and welcome to a special webinar from Fat Profits. My name is Roger Malik. I'm the head of our client services in our Sydney head office, and joining me today is our senior account manager, Edward Allen. Edward, welcome to the webinar. Interesting times. Hope you're well.
Yeah, thank you, Roger. Definitely interesting times. A lot going on. We've got war, we've got floods. We've got a lot to cover today, which is going to help investors make important decisions moving forward.
Yeah, absolutely. Good to have your company. Now, for those of you who are watching the webinar, I'll cover what are the main topics of discussion today. But as you can see, the headline, certainly the war situation with Mr. Putin and the rest of the world is a hot topic that's affecting the market. So we will talk about that, and we'll look at the fact whether the market crash topics that some people are talking about, that they're expecting a bear market, whether that's our opinion or not, or we see that as a buying opportunity. One of the things, of course, when wars happen is it affects nearly every part of our day-to-day life, even though we're far away in Australia, but it does affect many, many things. And we'll look at that shortly. But the topics of discussion today, first, we will talk about Russia versus the world. What's the impact? We'll also look at the ASX 200 as to whether this is a good time to buy or sell or hold. We'll look at the recently completed Australian reporting season, whether that was a hit or a miss and how the companies fared, and we'll give you some examples of companies that are reported good and bad so you can make some notes. Sector rotation, that is certainly happening right now as we speak. We'll look at our top stock picks as well from Fat Profits, who we are, what we do, and stocks. We'll not only tell you which ones to avoid, but also give you a couple of hot buy recommendations today towards the end. There's also a hidden gem, and in between that, we'll also give you some sell recommendations as well. So plenty to talk about. I can see we're nearly full house today as well. We did another one of these just in the last couple of weeks, and we had a full house back then as well, Ed. So it looks like people are interested in finding out what Fat Profits got to say. So look, before we get into our discussion today, all our presentations from Fat Profits are general information only. We don't provide any personal advice. If you're looking for that, please go and see your financial advisor or planner. And also, past performance is not a reliable indicator of future performance. Now, during this webinar, we encourage you to ask any questions. So type them in on your screen in the chat box, and we will answer those questions towards the end of the webinar, but certainly during the webinar as well. If they are topical, we will take your questions. So first up, let's have a look at the hot topic that is all over the news. It's affecting us. Well, I suppose the Ukrainian people, firstly, our best wishes to them. It's not easy for anyone out there, especially for them. But from us far away as investors, you've got to protect your capital in these crazy times, but also see what you can do to maximize any potential. We'll look at that first. So what's moving? Oil. That's the first thing which is moving, partly because Russia supplies 40% of their oil to the European Union. And because that's now been blocked, oil price has gone through the roof. And look, that's not really a surprise, but this is on the back of what's been happening over the last 12 months anyway. So oil is one sector. If you're holding, you'll be feeling some benefits. But if you're not holding it, that's something to check out. Another sector which has moved up off pretty low base is gold. Why? Because gold is considered a safe haven, especially in volatile times. You can see gold has now gone past $1,900 US an ounce, and we do believe at Fat Profits that gold will continue to push higher by the end of this year. So that's another sector that you can look at. Another thing which has been affected by the war situation, and even before that as well, is food inflation. The prices of agricultural commodities has now skyrocketed even further on the back of Ukraine and Russia war. Now, how that affects us, of course, in day-to-day life, when we buy food and veggies, that's been affected. So how can you benefit from that as an investor? Well, certainly you can invest in those companies in that sector. For example, wheat. Looking at this chart here, you can see over the last few months, the price of wheat has certainly taken a nice little uptrend, but in the last 2 weeks or so, it's actually spiked even higher. So what can you do with this? Again, there are companies on the ASX listed here where you can actually invest in those and benefit from rising soft commodity prices. So that's another opportunity which we'll discuss later. And look, of course, we know that one thing which has been going up and up of late is the core inflation in US, but also in Australia and New Zealand and pretty much most of the countries around the world. If you look at the breakdown, this is not going to be helped by this war situation, where you see the price of fuel, the price of gas, energy, food, and veggies and eggs, electricity, everything has gone up. This is over the last 12 months. So that's certainly not being helped by the war situation. Now, Ed, let's get your thoughts. You've been with Fat Profits for a very long time, I believe 11, leading up to 12 years now. You've seen a few situations before the markets have gone up and down crazy. But looking at the S&P 500, the US biggest index, we can see that the markets have gone up and down in the last 2 months. Firstly, in January, we saw a big drop from 4,800 down 15% in January because of rising interest rates being talked about by the Federal Reserve. Now we're seeing the war situation bring that index down even further. What's Fat Profit's views on the markets firstly?
Yeah, look, realistically, it's all been priced in at the moment. So leading up to this war, the markets were well priced in. You can clearly see that red line on the chart there that the S&P 500 has broken through to the downside. So it's testing those lower levels at the moment. Overnight, recently, you would have seen a lot of sanctions being put towards Russia, in particular SWIFT global payment system. That's going to affect the world globally, not only stopping Russia receiving payments, but also sending payments. So that's going to affect companies worldwide. The Russian ruble, it's at its lowest ever price at the moment, and that doesn't seem like it's going to stabilize anytime soon. World stocks have obviously slid as a result. We showed you the oil chart recently, and also gold. Sanctions have been biting, and the Russian central bank has raised interest rates to 20%. That figure would send jitters to Australian investors. They remember back in the 80s, we got to 17%. So, realistically, we've got to be prepared, even though now we know interest rates are rising. They'll rise post Australian election in May, and they'll probably rise a few times. New Zealand's already raised their official cash rate as well. So yeah, these fundamentals are clear. They're here to stay. They could potentially get worse. The good thing is we're going to show you some good quality stocks shortly that have reported well during reporting season. Dividends have been maintained or risen. So our stocks are well in tune for this volatility, and we'll give you some ideas in the coming slides.
Very good. Thank you, Ed. So our view on the market is, look, we are positive on the overall market. And look, one of the things to show you as well, and this is something we posted to our members just a few days ago, that this is history, a bit of a history lesson, if you like, where, Lord Rothschild mentioned that over 200 years ago, and he declared that you should buy stocks on the sound of cannons. And we mentioned that to our members as well, even though it might not make a lot of sense to some people. But this is a chart of the S&P 500 on the day when the war was announced by Russia and they started invading Ukraine. So on that day, the stock market actually went down 3% in the US, and this is the start of the day till the end of the day. And then slowly and surely the markets climbed. By the end of the day, they were actually 3% ahead. So Lord Rothschild might as well have been right, because the markets typically rebound after the war has been declared. That's just a history lesson. Why that happens? Partly because leading up to the war, the markets have already priced everything in, and there has been a huge drop already. And then, the volatility sort of starts to come down. Looking at the ASX 200, and I think this is where I'm going to ask a question from you guys. Because we have a full house of audience today, I'm going to pop a question on your screen to see what your thoughts are as to where the ASX will be by the end of this year. Now, having a look at this quickly first, you can see obviously over the last year and a half to 2 years, we've come off the March 2020 lows. We've had a pretty smooth run with the odd, volatile month here and there, but overall been pretty all right. The last 2 months, January and February, we've seen markets drop a couple of times. So our question now is on your screen, there it is, as to what you think is where the markets will finish by the end of this year. It'll be interesting to see, and I'll tell you the reply shortly in terms of what everyone thinks. So either you think the markets will go up between 5 and 10%, or over 10%, or down in that same order, down maybe 5 to 10%, or 10% plus, or do you think the markets might be flat, similar to where we're at currently? So Ed, while the people are providing their answers and views, what's Fat Profits think? Where do you think we will end up by the end of this year?
Look, the indication that the analyst team has been giving us and our members is that the market from here will more than likely be up 10% from where we are right now. Not all stocks will be up, some will be down. As you can see, speculative stocks have been sold right across the board. A lot of people have lost a lot of money in these smaller companies. The big technology and also small technology sector, retail stocks, there's been a couple of highlights, like Lovisa, for instance, recently. I mean, they've got an 80% margin on their product, so they're doing pretty well, but not everyone's going to be in the same boat. So some stocks are going to go down quite a bit from here, and a lot of stocks during these mini crashes, they just don't recover. It's as simple as that. So the good thing is we believe, the analysts believe the market will bounce the index, the ASX 200, 10% from here by year end. There will be a lot of volatility. Remember, we've got an election coming up in May. We've got interest rate rises potentially in June. That's where they're earmarked. And we do expect a Christmas rally by the end of the year. But between now and then, you can obviously make a lot of money if you buy well, but you could lose a lot of money if you try and catch those falling knives, which I'm sure a lot of investors have tried to do already. Yeah, it's going to be an interesting year ahead.
Yeah, thank you, Ed. And look, I can reveal the results from the answers. It's quite interesting because 54% of people watching this webinar have answered that the markets will be up between 5 to 10% by the end of this year. So cautiously optimistic. So that is similar to our views. And 28% think we'll be down between 5 to 10% by the end of this year. Look, we do disagree with that, but time will tell, and we will give our reasons. Others are mixed responses, which is obviously in the minority. So let's give you a few reasons as to why we think the ASX will end up higher this year. First thing first, if you look at the sector breakdown, you will see the ASX is heavily dominated by the financials. 31% of our ASX 200 is financial companies, followed by 17% in materials. And this is where we are different than some of the other global markets. And then the third biggest being healthcare, and the rest becoming smaller and smaller. If you look at the reporting season, the health of our top 200 companies, and I'm going to read out a couple of these things to you so you understand. So under 67% of the companies that have just reported the half-year results have lifted their profits. And this is above the long-term average of 60% of companies reporting better profits. And the other thing which is interesting is the cash holdings. And you look at the bottom one here, the cash holdings have actually lifted by 60%. And out of the 164 companies, out of the top 200, they're sitting at $246 billion in cash as of 31st of December last year. And this is a huge figure. And dividends have also lifted by nearly 6% as well. Have a look at the charts, and if that makes it a little bit easier for you to understand, the cash levels, this shows you the cash levels have gone up over the last 12 years on the ASX. And this is the highest cash levels that the companies are sitting on. And you can clearly see a huge jump, in fact, double than what they were at 10, 12 years ago. Now that has got to be a good thing, because you're going to get more in dividends, more in share buybacks, more mergers and acquisitions as well. Next thing to look at is dividends. Are they back? Well, we can feel that in our bank accounts when we're getting those dividends. I can, I'm sure you can, Ed. But
Yep,
the dividends have improved, haven't they?
definitely back.
Yeah, you can see that there as well. And look, finally, the final piece of the puzzle is also where to from here, the forecast. And this is another interesting stats, and these are all from the analyst estimates in the market. And again, I'm going to read that here. You can see the blue line on the chart. That's Australia. This is earnings estimates going forward from here. And you can see the other peers in Asia, including Singapore, Japan, New Zealand, and Hong Kong. The growth forecast for Australia is above 7.5 to 10%. And you can read that in the commentary. The Australian earnings per share growth of around 10% is expected in fiscal year 2022, and with the February company profit results above market expectations. And this is being led by resources, being forecasted to be up around 8.5%, and banks up around 8%, leading the way, and strong commodity prices and rising interest rates is going to be what we're expecting. So hopefully that gives you some snapshot on why at Fat Profits we believe our Australian market are well placed to benefit from the current state of play. Now, having said that, how do you play the market is going to be interesting, because as Edward mentioned, you could still lose a lot of money, you could still make money. It depends on the decisions you make today. So one thing we do at Fat Profits is the reason or secret to our wealth that we've created here is we follow Warren Buffett's philosophy. And one of the things he does is he becomes greedy when others are fearful, and fearful when others are greedy. Now, there's no benefit in sitting on the fence when the markets are so volatile. You must take some action. If you're sitting here watching this webinar today, you want to take some action. You want some information which will help you. And by the end of this webinar, we will give you lots of quality information. And one of that, as a takeaway, is take action when the markets are going down. And that's where you're going to make money. And this is a clear chart which shows you the difference between greed and the emotions during that time versus fear and the emotions during that time. And this is when you've got to buy, when the markets are down, and you've got to repeat that over and over again. So these guys, Warren Buffett, Charlie Munger, I mean, they're well into their 90s now. They don't make money by buying and selling stock. They're not traders. They make money by holding stocks for a long period of time. And this is the difference. Now, when I first started investing, I became a trader as well. I thought I could trade every day or every few days and make a lot of money. It didn't work. I learned it the hard way, and I'm sure some of you have tried it as well. Buying and holding quality companies, doing your research, and holding them for a period of time is what generates wealth. And if you again remind yourself, here's an example. Collins Foods, this is our biggest holding in our Fat Profits portfolio. Who are they? They own all the KFC franchises and Taco Bell restaurants in Australia. Simple business, recession-proof business, if you like. We've had it for 10 years, bought it at $1.36. We've held it and held it and held it, and it's gone up over $11, $12 during this time. So this has gone up 10 times in 10 years. Now, how many stocks do you have in your portfolio right now that you're sitting on, which are up 10 times in 10 years? If you've got 2, 3, or 4 stocks like that, that is a game changer, because that helps your portfolio lift. They also pay dividends, which is nice along the way. So this is how we create wealth at Fat Profits. Now, Ed, let's look at a few stocks that have reported their earnings recently. First one is Nine Entertainment. Some people watching this may be holding this stock, but this stock has reported pretty good earnings. So can you give us a quick snapshot on what's to like about this company?
Look, brilliant. They're transforming into an online technology company. So obviously there's Stan there, and they've released some pretty high quality shows recently, like Gold, for instance, which is highly rating. They also had record ratings for the Australian Open, mainly because the Australians fared quite well in that tournament. So record ratings there. They've just signed a new agreement with the NRL, Rugby League. Just quality shows. 60 Minutes is a highly rated show as well. So their earnings continue to grow. They've paid a fantastic dividend, and one of the best stocks that are reported in the most recent reporting season. So long-term hold for fat profits. I remember during 2020 it dropped to about $1.11, and we did put out a midweek alert to members, similar to Collins Food, the one that you showed recently. The midweek alert was under $4, and it bounced over $4 on the day. So this is what we do. We target these high quality stocks, and we buy them when they're down, and we hold them when they're performing well, which is what's happening currently.
Very good. Thank you for that. Yes, so Nine Entertainment is a buy. So if you are looking for some ideas, that's one stock, and you can see that the initial buy was $1.08. We've held this stock for some time. We also sold half at $3.02. You can see. So we not only tell you when to buy, we will also tell you when to sell. And we've sold half there, but we've held the other half. Then it dropped to 264, and we put another buy on it. So now this stock is back on the move. So that's the first one. Rio Tinto, Ed, they also released the earnings, and it had a record dividend of $10.40, which has never been bigger in the Australian market, the biggest dividend payout in the history of the ASX. What are your thoughts on Rio's results?
Look at that, net earnings 116%, consolidated sales revenue 42%. The numbers are there. It's very clear. Total dividend, 2020, you can see that. Plus the comparison's 87% from 2020. It's incredible. So free cash flow plus 88%. Net cash, it's incredible. Look at the 2020 net cash. It was negative. Now it's 1.6. So this is a stock that's done very well for our members. We bought it a few times, took a sell half back in 2019.
2019, yep.
Yeah, so that was fantastic. Same with BHP as well. So we've done very well, and we've always bought this stock on weakness. So you can clearly see on the charts there, $80, $99. It's always gone up. The sell half was timely. Could have bought it, sold it 104, bought back at 80. That's something our individual investors, some of our long-term investors that I speak to, they tend to do that if they can time it well. Most just let it run because they've already bought well, but if you can time it well, you can do very well out of these stocks. So another solid performer for fat profits.
Very good. And highlights the results or the health of the ASX as well, especially our big miners. But another stock in a different sector, insurance. I mean, insurance is generally a sector which some people don't particularly like because they can't stomach the volatility. So this might not be for everyone. But QBE, just as another example, they also reported their earnings, which actually, compared to last year, grew by 33% in North America and otherwise as well. They've also reported better dividends as well. So all up, look, this stock is not going to be the star stock in anyone's portfolio, but they do pay a steady dividend of between 5 and 6% with rising interest rates, both in US and Australia, because they have earnings in both the markets. This company is going to benefit. They also have rising premiums. Yes, of course, there is some floods around Queensland, northern New South Wales, but they'll price all that in. But typically speaking, medium to long-term investors, this is not a bad stock to have in your portfolio. Good earnings result as well. Next stock, this is very interesting because Hub24, not only the share price is going up, but this company, Ed, have won the best financial platform in Australia award for 6 years in a row. And the earnings are absolutely phenomenal, which is reflected in this chart. What are your thoughts?
Yeah, total funds under management, 68.3 billion. When we brought this stock in back in 2013, it was a small cap. Look at it now, 68.3 billion. So another success story. Half-year dividend, 7.5 cents per share. That's up 67%. So again, another stock that we recommended many years ago. and we kept updating members accordingly. We know this stock well, we know the management. So when we put a buy on this stock, we are very confident that the underlying earnings is continuing to rise. All the other metrics will continue to follow. So you can see that the initial buy, $1.35. We even bought again at $20 back in 2021. It went as high as 36, almost $36 late last year. It has been on a bit of a decline because the market has been a bit volatile, but usually on good solid green days on the ASX, Hub's right up there as one of the top performers. So the money comes straight back in. So, but again, you could have played this stock. I mean, if someone is clever and timing is good, this is another very good stock that you could have played off the highs and lows and made quite a significant amount of return. But if you had just held it, which is what we did, even in our managed accounts, I believe it's one of our stocks as well. We've just held it all the way through, and it just continues to compound each year.
Yep, very good. So a small $10,000, if you put in this stock as an example, you'd be sitting on $175,000 in the last 6 years or so. And that's a phenomenal outcome. From a small cap, it's now become one of the top 200 ASX companies, also pays a dividend. So that's another stock, and these are the type of stocks we can recommend. The last stock in the reporting season highlights is Aurora. This is a packaging company, really boring sort of company, nothing really sexy about it. But if you look at the earnings, again, highlights another sector in the industrial space where the earnings have improved. The dividends have gone up as well to 8 cents a share, up 23% from a year ago. But the underlying earnings are up 23% as well. So overall, lots of ticks in the boxes. And this company also has gone up, and you can see in the share price chart. While again, this is not a typical 5-star stock in anyone's portfolio, but it's a boring defensive stock. But guess what? In volatile times, we all need a couple of these stocks in our portfolio. And if you look at the share price here, only 12 months ago it was trading around $2.60. It's now around $3.60, so it's up around sort of 40–50%, and also pays a dividend and pretty steady in volatile times as well. So this is another good example of the health of the Australian market. Now, who are Fat Profits? Look, Fat Profits, we're not stockbrokers. We're a stock market research firm, and we have offices in Sydney, London, and Auckland. We also have a wealth management division. You can see our timeline here. We first opened our office in 2000. The picture you see on the right, that's our CEO, Angus Geddes. He's based in our Sydney head office. He's also a fund manager. He's originally from New Zealand, and you can see he actually won an award from the New Zealand Chamber of Commerce for when he was a teenager, only 17 years of age. He invested $200 and turned that into $35,000 in the world stock market. So he's obviously got an early knack into stock market investing, and he's worked all around the world before he opened Fat Profits. He's well renowned in the stock market. You may have seen him on lots of TV channels. We also provide research on global markets. We're not just an Australian stock market research firm. We have companies, we cover different markets, including Australia, New Zealand, Asia, US, UK, and Europe as well. So if you're looking for good quality research on which stocks to buy, when to sell, what to hold, all that without paying a stockbroker and without investing in a managed fund, and you managing your own money, well, then Fat Profits can help you, and you pay a very small annual fee just to come on board. Now, with David Lennox, Ed, you worked with David for a number of years. David's in his mid-60s, you know him quite well.
Yeah, seasoned geologist. Used to work for Colonial Mutual Life. So he's well regarded. He's also worked for the Suncorp Group, and he's held positions here at Fat Profits as an analyst, portfolio manager, and fund manager, prior to Fat Profits, and he's purely a mining analyst here at Fat Profits. So people trust David. You probably see him on Ausbiz, CNBC. You see write-ups in the Australian Financial Review from time to time. as well. So he's well regarded. He's the go-to. So when the market's looking for comments on Rio, BHP, Woodside, Santos, some of our biggest mining companies here in Australia, Allchem as well, they go to David for comments because he's got his finger on the pulse. He's predicted the super cycle back in 2020. You know, we got into all these stocks like South 32 and Independence Group and so on, and all these smaller nickel and copper stocks. They were all his picks. All infrastructure ready stocks, which are continuing to grow in our portfolio. We've got a very solid mining portfolio. That's what he specializes in, and a lot of members have made very, very profitable trades from David's recommendations. The biggest one being Chalice Mining, which is the biggest performer on the ASX in 2021 and 2020 as well. So, and there's many more to come. He's got a few stocks. I know we had a chat recently about stocks that he's been looking at. We don't want to overflow the portfolio, but with the recent sell-off in the markets, he does have about 4 or 5 stocks, especially in the battery and renewable space, the green energy space, that he is reviewing currently.
Yeah, we just received a comment from Margaret, who's watching the webinar. Margaret saying, I've listened to David on many TV channels before. He actually makes a lot of sense, and I really appreciate his insights always. Thank you, Margaret. Also, just a quick fun fact, only a couple of weeks ago, during one of these webinars that we did for non-members, there was an 85-year-old chap in Melbourne who used to work with David many years ago in Colonial, and he listened to the webinar, and then I spoke to him afterwards, and he said, can you say pay my regards to David? And I said, how do you know him? He said, we used to work together back in the day, and obviously Jim was his name. Jim was a senior because David's only 65 and Jim's 85 now. So he said, I remember he was a young boy, but he was pretty sharp, and he said, I appreciate his comments and I want to join. So he joined for 2 years, Ed, and he said he actually likes David's insight.
It's never too late to join. 85, he's a young spring chicken, probably still buying green bananas. But that's what they tell us. But yeah, it's never too late to join. So if you're managing your own portfolio in your 80s, the chances are you'll be managing it to the end and leave a nice nest egg for the family. You got your finger on the pulse and in full control. So we provide you with the information to continue doing that confidently.
Absolutely. And look, finally, we also manage real money in the stock market. Angus, our CEO, he's a fund manager. So this is a chart of the orange line versus, which is our Fat Profits portfolio for Australia, and the black line, which is the ASX 200. Our portfolio is up 338% since inception in 2007 versus ASX 200, which is up 122%. So we nearly tripled the ASX over this period, and goes back to the previous point about the Warren Buffett philosophy: buy, hold, manage a portfolio, be active, keep an eye on the market, and you can make serious money. So that's what we've also done. Now, the other topic, just before we look at a few more buy and sell recommendations, and I will take you, in fact, we are going to show you our members' website today. So I am going to log in and show you a bit of a sneak peek. But before that, sector rotation, that is happening pretty much regularly at the moment given the war breakout. But one of the key things, as we talked about before, is the Fat Profits, the financial and commodities are the 2 big sectors that we are bullish on for the year ahead, and in fact a few years from now. Commodities, we are in this new super cycle, and that is for the next 3 to 5 years. We think that's going to be a huge component of creating wealth for you. Financials, absolutely, with interest rates rising and the backdrop that we're facing, that's a must for investors. Property, maybe the big gains have been had. The prediction now is the property sector to go down, and technology, certainly you have to be very careful if you are still holding tech stocks. Look, there are quality tech stocks. If their earnings are on the rise, fine, but there are multiple where earnings are actually on the decline, and this is an example of what's happened lately. The red line is the tech sector, and the blue line is ASX 200. So the tech sector's taken a hammering, and that's not a surprise. So you have to be really careful. But what we want to show you is we've received numerous requests from people looking for dividend information. People want high dividends and income in semi-retirement or retirement. So this is, as an example, and you might want to highlight this, but this is our performance chart of our dividend portfolio. So do you want to highlight some of the key features?
Yeah, look, we've been running this since 2012. It's part of our Australian equities portfolio or our Australian equities report. So the good thing is, unlike a lot of our competitors, we don't have multiple products. So when you join Fat Profits, we have one product with a number of research portfolios. So it's either standard, premium, or platinum, but this is part of our standard membership. Australian equities, and within that we have an income portfolio which is updated 4 times a year, and we'll add and remove stocks at that time. It included, see the dates there, it's all very in black and white, but we predict the dividends at the moment. We're predicting dividends for 2023 on all of our stocks, but it's well diversified. You've got financials, diversified industrials, and property, 3 sections. The property stocks are great, even though they're unfranked, they pay half yearly and yearly dividends. So if you're on a drawdown phase, a lot of our older members that are drawing down from their super fund, they can balance out their dividends throughout the year. Now, typically the banks pay in the last quarter of a year, apart from Commonwealth in the end of the first quarter. And we show whether they're franked or unfranked. But you look at those numbers down the bottom, it's quite extraordinary. And you can see that it's all there in black and white. So, you know, full year 2022, 6% gross dividend. That's including the franking credits, and then 5% excluding. So even though you can see in that last column, the franking, you know, almost half of the stocks almost are unfranked. So I have a lot of members over the years saying, oh, I'm only looking for fully franked dividends. The savvy investors also put in the unfranked dividends and balance out the portfolio and diversify, spread the wings wide rather than thin. And that's how we show you. And we've highlighted a couple of stocks there. You can see on the left, and these are in the current portfolio. You know, BHP just recently paid a whopping $1.50 dividend. I mean, that's extraordinary for a self-funded retiree. And you can see it's diversified. You know, quick service restaurants, Collins Food, James Hardie Building Products, globally, Nine Entertainment, Aurora Packaging, and so forth. So this has been an extraordinary portfolio, and the overall return, I believe, was around 18% annualized over that 10-year period. I mean, anyone will be happy with 18% per annum at the moment, especially in this current market. So that's the average return, and the total return, you can clearly see it there in black and white. So yep, just another reason to join and get this information for yourself.
Thank you, Ed. Yeah, look, this is just to summarize. I think you've made a couple of good points. This is our performance of the portfolio. But we're obviously not showing all the stocks here on the left, so we blurred them out just to protect the IP of paid members. But the returns, you can clearly see capital returns here, the income returns and dividends, and the total return in the portfolio, over 50%. And the annual returns on the bottom right, that's the key, 18.1% per year. This is we're generating out of the top 200 ASX stocks. And that's huge because most people will be happy with a 10% return a year, including dividends, but we're generating 18%. So you must ask yourself the question, what would that extra 8% do for you? How much would that mean in dollars? And these are all top 200 stocks. And as Ed said earlier, this is the forecast in terms of dividends. And you will get all of this as when you become a member. You'll see the 22 stocks on the left. They're in different sectors, financials, industrials, and property. You'll see the dividends announced per share for each company. What are we expecting in financial year 21, financial year 22, net yields in percentages, gross yields, including franking credits. And at the bottom, you can see the portfolio average expected is 6% in dividends for the financial year 2022. So that's a pretty healthy looking dividend return. But the key thing is this is also generating another 12% on top in growth. So all up, you're getting 18% a year. You know, you can't do better than that, honestly. And if you are, well, hats off to you. Let's look at a few stocks now.
Just on that, Roger. That's 22 stocks out of our total 55 preferred stocks in the market out of our Australian equities report. So it's less than half that's put into a separate portfolio. that we monitor. There still are other dividend stocks in our Australian equities portfolio that you can consider as well.
Absolutely. So that's a really good part of our service. Now, also, let's give you a few stocks that we've avoided and we're still avoiding at the moment. So if you are holding any of these stocks, this might be some insights for you. Look, first up is ZipPay. We've looked at Afterpay in the past, Kogan, AGL, Appen also recently announced their earnings. And all these companies, look, they've had a lot of interest from investors. Unfortunately, they're all on the decline. So Zip, let's have a quick word on that, Ed. They've recently announced the earnings, which were not that flash. The stock were down recently as well on their day of announcement. And they also announced recently a potential merger with Sezzle. What are your thoughts?
Yeah, we said for the last 2 years that this buy now, pay later sector will eventually consolidate, and it's already started with Afterpay moving in with Block, which is now Block, and that's a good move. This is probably going to be a very good move because $80 million in synergies in savings per year. Even though ZipPay reported a loss, they halved their loss from 2021. So with these 80 million synergies, look, potentially a player, but probably going to go down before it even gets close to going up because it's going to create dilution and the sector is clearly underperforming. So it's one that we've put on a watch list. We research the entire market, even though we don't recommend this stock. We do research the entire market because we provide information and sector reviews to our members. The buy now, pay later sector review was a really popular one. So was the crypto review. But yeah, just a watch, a stay and watch on this one. It's going to be interesting to see how this one plays out. Look, could potentially halve from here. Nobody knows it, but it could also double from here. So generally, it's not a stock that we would add to the portfolio right now, only because we're risk averse at the moment in these volatile times. So we want good quality companies that can grow, pay good dividends, and we can buy well during mini crashes. Yeah, it's going to be an interesting play.
Yep, absolutely. This is the exact opposite of what we showed earlier, where earnings are on the rise and stock prices following. This is the exact reverse, where the earnings on the decline and the share price is following. You look at the next one, Afterpay, that's another stock. Of course, it's no longer on the stock market because they've been bought out, but they've also been on the decline as well, leading up to their buy. So we've been avoiding that stock. Another stock we've avoided is A2 Milk. So if you're contemplating that, our general advice today is still, it's an avoid from fat profits. This share price has come down from $20 at its peak down to $10, $12, $11. And some people wanted to have a piece of it at that point in time. It was down 50%, just based on the share price chart. But really, you've got to do more research than that. And you look at the price now, it's just about $5. Some people thinking now as well, could it be a good time? But look, at $5, it's probably better value, but there's still a lot of hurdles that this company needs to overcome before the earnings start to really rise. So at this point in time, we're not interested, we're avoiding it, but we're keeping an eye on it. Kogan.com, the online retailer, that's another stock which has had its peak. $26 was its highest, came down half to around $13 at one point. And again, we were getting inquiries from our members even saying, should we buy this? This looking pretty cheap. We looked at all the fundamentals, the operational issues. We avoided that stock. We said, look, we don't really like the fundamentals at this point in time. And look, in hindsight, that turned out to be good because now around $6 or between 6 and 7, we're still avoiding it unless things turn around. And last couple of stocks, look, AGL, they have been in the news lately because they've received a takeover offer from a consortium. So the stock has had a bit of an increase from 6 to sort of just about 8 or between 7 and 8. But look, we're still not that keen on this company. They've got a lot of problems to sort out. At this point in time, it's not looking very good from our point of view. And the last stock is Appen. Appen have had, again, their time in the sun. They were as high as $44, and they've seen the share price decline because the earnings have taken a huge hit. And recently, they also announced the earnings. The stock was down 28% on the day of the announcement. Not looking the greatest. It looks a little bit sick, to be honest. And if you're holding that stock, I know how you feel. And we're not inflicting any pain, but we are suggesting for any new investors looking at these companies currently, it is an avoid. Now, moving on to stocks that we have bought, and we'll give you our top stock picks. Last financial year, these are the top 10 stocks on the ASX 200, and the best stock was Chalice Mining, CHN. The third best was Hub24, which we've just seen previously, and the fifth best was Orocobre. So the first, third, and the fifth, they were picked by Fat Profits. So we were very proud of that, because it's not easy to pick 3 out of the top 5, let alone top 10, and we have managed to do that. So just quickly to show you Chalice Mining, that was easily the best stock in the ASX last year. They've got numerous mines across Australia that cover nickel, copper, and gold, and they've had some huge discoveries. And this stock, you can see in the share price chart in a minute, but this particular testimonial is from a young 33-year-old member, Grant, and his whole family is a member with us. I have spoken to him before, and his father, Ian, his father-in-law, Ian, introduced him to the service. He only put $5,000 into Chalice at 12 cents a share, and then he bought another $3,000 worth at 18 cents. And then he's put in a little bit more money. That stock has turned into $500,000 for this guy, and plenty of others who've actually turned, $10, $20, $30,000 into a couple of $1 million, and they have obviously been very happy. Ed, you probably heard some stories similar.
Heaps of stories. So the thing is, at the moment we're in March 2022. So 2 years ago was the start of the pandemic, and a lot of members that I'm starting to renew. We've actually got a record amount of renewals this month, the highest ever at Fat Profits, similar to what happened in 2009 after the GFC. Investors just rang our main line. It was like taking tuck shop orders for 1 and 2 year memberships, because they trust us. When the markets reverse, it's too late. So you got to get in as the optimism starts, and that's what happened back in March 2020 when the markets dropped. We had numerous amount of new investors like this gentleman who joined for the very first time. Most took out a 1 or 2 year membership, but most took out 2 years, and I've seen them. There's hundreds of them, that we need to call this month and next month as well in April. So these guys have all made money out of the service. 2 years ago the market dropped substantially, and they all got into these types of stocks. And if they followed our strategy, they've probably taken a bit of a sell half along the way, but they'll still be owning most or part of that stock at the moment. And they've made a lot of money. So the members that I've been renewing at the moment, very happy, made plenty of money, and they know what we did 2 years ago, and they know what we're doing now. So they'll do very well going forward.
Excellent, thank you, Ed. The third best stock in the ASX last year was Hub24. We won't spend too much time here. We have covered this earlier. The earnings have certainly gone up, which you touched on. And if you put in $10,000 into this company, you'd be sitting on $175,000 today. Unlike Chalice Mining, you'd be probably $500,000 plus, but still nothing to sneeze at. That's been a very good outcome for our members. And look, commodities, and that's something as we talked about earlier, at Fat Profits, we believe we're in this huge super cycle, which has only happened 4 times in the last 100 years. And we believe we're now in the 5th super cycle in commodities. And part of that is, you can see some hot stock commodities are nickel and lithium. And Ed, these commodities are on the way up, but the demand keeps on surging.
Yeah, battery metals. So you've got lithium, you've got cobalt, you've got copper, nickel, rare earths. These are all the battery metals, and they're very, very high demand globally. But Australia is well positioned. See, globally, China in particular trusts Australia. That's why our iron ore producers are the #1 rated in the world and most trusted. So we are to go to a country to buy commodities from. Our Australian dollar remains quite low, so we're quite attractive. But you can see there the 5-year chart. Look, don't get fooled. There's a lot of exploration. There's a lot coming on stream. A lot of new IPOs for lithium in particular have hit the ASX in the last 2 years. So there's plenty of it, but the cost of extracting now is going to be almost twice or 3 times what it was a couple of years ago because of inflation. So a lot of these Western Australia explorers that have found plenty of commodities under the ground and have built up their resource bases haven't drilled a single hole of infrastructure in the ground. Our stocks are well positioned. We've done very well. We'll continue to do well. A lot of those stocks have pulled back with the recent mini crash in the market, or mini crashes. So it's a good time to buy these. The merger with Galaxy for this particular stock, Allchem, which used to be called Orocobre and Galaxy, is fantastic. Multiple sites, multiple productions, well ahead of the game, and very well trusted producer of lithium concentrate. So well positioned for further growth in years to come. This stock will be one of the large, I think it's the 5th largest at the moment globally.
Yes, fifth largest in the world, yeah.
It'll grow even further. They'll probably, just like with the Galaxy synergy, reducing their costs, operational costs. There will be others. They'll be on the acquisition trail. They'll buy out some others as well in the future. So good stock to own.
Excellent. So that's another one for us. Now, the other thing also is we do have lots of sell recommendations as well. So not only we tell you what to buy, what to avoid, which you've seen some of that so far today, but we also tell you when to sell the stock and whether to sell all of it or half of it. There's a few examples, Boral being the first one there. This is last year, in the last 12 months, in fact. We bought at 405, sold half at 741. So if you'd invested $10,000 there, that's the capital growth, and the list goes on. You know, we're not perfect. So look, some of them, while they're phenomenal, like Mainstream, for example, at 10,000 turned that into 47,000. But look, we have had a couple of losses as well, so we don't get everything right. We are realistic, but majority of the times, look, 10 out of the last 12 sell recommendations have been positive. So that's something to keep an eye on. Let's look at our yearly results now. Because we're medium to long-term investors, I think you must put us to account on our results, and that's how you should look at anyone, whether it's a stockbroker, whether it's a market research company, or anyone you're talking to. You must put them in the results category. So our results are very strong, and this is our results since 2000 when we first opened the company. We've been averaging nearly 18%, so 17.8% to be exact, versus the market, which has done 8.5%. We've been outperforming the market year on year by 9.3%. That's not a small number. And you know, if you've got 100,000 invested in the market, that's an outperformance by $9,300 a year. And of course, it's if you've got $1 million or more, it all adds up. Now, does that mean every year we go up? No. And these results are on our website, so you can check them out. We are very open and transparent. All our results are publicly listed. So if you look at the yearly breakdown over the last 6 years, in 2020, we actually did 20% return. So we had a good year versus the market, where the market was only up 3.6%. But in 2019, look, we got up by 19.3%, but the markets were up 24% anyway. So we're not taking any credit for 2019. In fact, we should have done better. So we will take that on the chin. But 2018, we have to take credit because the markets were down in the red, 3.5%. We were ahead by 10%. So that was a pretty good outcome. 2017, we doubled the market. 2016, we doubled the market. And 2015 was probably one of the best results when the markets were down by another 3.5%. We were ahead by 18%. So that's an outperformance of 21%, which is huge in anyone's portfolio. So that's to give you some confidence in our published, verified, audited results, which are on our website for millions of investors in Australia to see. And this is all black and white. Now, looking at how this translates in dollars, it's pretty simple. Look, this is a simple chart of compounding interest. So if you had invested $10,000 back in 2000 into our recommendations and followed that, and you chucked in another $5,000 a year, every year for the last 20 years, you would have turned that into $1.6 million over the last 20 years. Now, is that realistic? Probably not. So even though you may not follow that exact principle, but the idea behind showing that is to give you an idea of annualized success from 1 year to the next. If you can maintain that for a long period of time, you will turn these even smaller investments into something big. And I think that's the concept that we follow at Fat Profits. And if you're not doing that already, if you're chopping and changing too much, you're trying to trade and time particular stocks, you're probably not going to see that sort of outcome over a long period of time. So that's something to think about. Now, Ed, I might even show people in a minute our sneak peek of our members area, but we've also seen lots of reviews from, I suppose, happy members on our website, and this is a couple of
Yes.
examples here.
Yeah, this one I know clearly because I've renewed her membership twice. I think she's been with us for well over 10 years now. But these are members that put up their own reviews. We don't ask them to. And she's definitely called me many times over the years. But she's done very well during COVID in particular. I know because she bought at the bottom and she's holding those stocks. She used to be with a stockbroker, and she's told us she won't be going back. So she's confident now. She can manage her own portfolio. It's very clear. If you just go to product review, you'll be able to see legitimate reviews there. There's a couple of dodgy ones, which are probably not investors, but you'll get that with every single product. People just vent frustration. But look, a lot of those reviews are in the last probably couple of years. A lot of new investors have come on board, and they really appreciate how well they've done just by simply following our recommendations and advice. You know, Alan Jones, he's a common member that calls in on the main line quite regularly. I know these names. I'm not sure about Nick, but mining, you know, a lot of younger investors get into the smaller mining stocks, and they've done very, very well. So we've got multiple success stories there. The good thing about our stocks, we always look at shares on issue. Even though a lot of our smaller miners have done share consolidations, they're tightly held. So when the share price goes up, they're not generally your typical day trading stocks where if you buy at the top, you get burnt. The day traders pull out and the share prices crash. So that's why these guys are very happy, because those stocks have continued to grow in their portfolios, and they've bitten the bullet. They haven't made the emotional decision of taking a quick 10 or 15 or 20% profit. You know, these guys are sitting on, in most cases, 100% returns on most of these smaller mining companies. So yeah, these are just some of the happy members, but I speak to them every day, and a lot of them tell us, yeah, we got 1 or 2 wrong, but we got 8 or 9 right. And that's why we're making money from your recommendations.
Yep, excellent. All right. Now, just before we look at the sneak peek of our members area and give you some insights, look, our performance is certainly right up there. You'll be very hard pressed to find someone who's done better than us over a long period of time, 21 years. Certainly when you're looking for good experience management, look, we've been around for a very long time. We've got some names like Angus Geddes, David Lennox. These are people who are trusted, and they manage a lot of money in the market. Now for today, what we like to do is, if you're interested in our service, you want to change the results that you're currently getting, you want to do better going forward, we're offering up to 50% discount for you to join our service. Now that's a very good incentive for you to take some action rather than sit on the fence, which is the easy choice. Take some action today, join a service, try something different. If it works, you'll be very happy. So we've got 3 types of memberships for you, and I'm going to show you in a second our website so you can actually see how it looks like. So these are the 3 types of membership. We have standard, premium, and platinum. Now, whichever one you join, we give you a tax invoice, and it is most likely tax deductible. So that's another little bonus. We can invoice that to your self-managed super fund or your own personal trading name, whatever you like. The differences between the 3 memberships are, with the standard membership, the first 3 benefits, they're common in all 3 types. So you get the daily Fat Chat market commentary. That's an email every morning before 10 a.m. It'll hit your inbox, and it comes from our CEO, Angus, about the markets around the world. Very good email. Second, you get a members-only webinar every Thursday and live at 12 p.m. Sydney time. Now, if you missed the live session, not a problem. You will get a recording. You can replay that at any time. So that's every week, and our team comes along, talks about the market, and gives you some real stock tips as well. On a Friday, we do a Friday Fat Wrap, which is a wrap up of the week, any major highlights that you may have missed out on. So those first three benefits are stock standard in all three memberships. The difference between the three is we publish 4 weekly reports. So in standard, you get access to one of these 4. With premium, you get access to 2 out of the 4. And with platinum, you get access to all 4. And with premium and platinum, you also get an account manager. So someone like an Ed, who's our senior account manager, you can speak to him, you can talk about your portfolio, you can discuss your stocks. But the difference is also in the reports is this Australasian equities report that covers Australia, New Zealand, and a little bit of Asia, and that covers all the major sectors of our market. So that's a must. It also includes the dividend portfolio, which we looked at earlier, also has growth and dividend stocks. So that's a must for everyone in Australia. Second report is global mining. Even though the name suggests global mining, some people think, oh, it's international mining company, so maybe I don't. But 80% of these mining stocks in that report, they are Australian mining companies, and the remaining 20%, they are international mining companies out of UK or Canada or South America or Europe. So that does provide that. Then you've got global equities, which is US, Europe, and Asia. So those markets are covered. And then finally is UK equities for that market. So our most popular bundle is a premium membership, where you get access to 2 of those reports and an account manager. Nearly 70% of our members are premium. Then about 20% are platinum members who invest overseas, as well as local, and about 10% are standard members. Now, before I show that to you, Ed, I think you have a special announcement today as well, because we've received some inquiries lately on portfolio reviews.
Yeah, look, we can't offer them to everyone, especially this month, because we've got so many members to call for renewals. But look, over the years, we're happy to provide a portfolio review. A lot of new members come to us and they say, well, look, I'd love to join, but I want a second opinion on my current portfolio. Look, I'm happy to do portfolio reviews. We just have to time them. Sometimes we can do them after hours or before hours or during lunch breaks, but that's fine. But look, any member that joins on the premium or the platinum, we're happy to provide a one-on-one portfolio review. We'll go through each one of your stocks and provide an opinion on those stocks. Some we may already cover. They'll be easy. The ones that we don't, I'll look at the technical and fundamentals on that stock and provide an opinion. Can't provide personal advice, but we can provide an opinion. So we can't tell you to go and sell it or buy more, but we will give you a second opinion on that stock. So generally, if it's a preferred stock or sector, we'll let you know, and then we'll give you a couple of ideas regarding diversification, some other ideas as well. So we've got to have that conversation on today. That's the premium account management service. You'll get an account manager designated. That's where you can just ask some questions or clarify anything that's in the report. We're happy to help. That's the differentiation between us and our competitors. We're not a direct marketing business, okay? If you sign up to one of the competitors there, some of the newsletters that are out there, you put your email address in and you will get absolutely bombarded. I'm sure a lot of you have already experienced that. So if you click on one email, another one will come probably the same day or within that hour. We don't do that. If we send out some ideas or updates to investors, it's a genuine update from us and you will not get bombarded, okay? So all the resources that we use is purely for our members. The only time we do, to be honest, a little bit of marketing is these webinars, because they actually explain the service, they explain what you get as a member, and they show you how you can benefit as an investor. And that's pretty much it. So it's a good snapshot of a service. But look, most members sign up to the absolute Australian equities report, which includes the income report. And especially in this super cycle, this commodity super cycle, I highly recommend you get the mining report as well, because plenty of money to be made there. Not only as a new investor, but also to diversify in your long-term portfolio or your self-managed super fund. Most of those stocks are in the ASX 300, top 300, so you can buy them even in wrap accounts, super wrap accounts, or even in our super profits platform. where you can actually buy those shares yourself. And there are some outside the top 300 as well. But here's a snapshot of our members area live. This is Roger's account.
Yes.
As you can see in the top
So
right-hand
once you remember, yeah, exactly right. So once you remember, so this is what you'll see. This is my account. I've logged in. You can see the members homepage, and if you scroll down, there is a short video which actually introduces you to the members area. You get familiar with it. But we have these 4 products on the left. You can see the Australasian equities, and you can go through these tabs. We've got the UK equities, global equities, and global mining. So that's all we've got. Once you subscribe to it, you have access to all of it. And to give you an idea, you get a weekly report from each of the products and covers lots of stock recommendations each week. You can also see the latest stock recommendations here. You can have a look at our Fat Profits portfolio, which has got 50 to 60 stocks currently. All our past winners and losers, everything is here. So we get about 7 out of 10 right. So you will see all of the winners and losers there. Any alerts midweek that if we see a stock goes up or down due to an announcement, which is sensitive, we will alert you via email, and it will hit your inbox in the middle of the day. So you can read a quick 1 page to see what to do. The income report that we looked at previously with 22 stocks in the dividend portfolio, that is here, updated 4 times a year, and that's generating 18.1% returns per annum, unheard of out of the top 200 ASX stocks. So you can access all of that stocks here, and all our weekly members webinars, they are recorded and live here. So you can replay the recording from there. So this is basically a snapshot of how the members website looks like, and that's something you will immediately have access to as soon as you become a member. So now what I'm going to do is I'm going to bring it up on your screen, because I'm sure a lot of people are interested in taking up the up to 50% discount today. So you can choose standard, premium, or platinum. And remember, with premium and platinum, we are offering a portfolio review as a one-off.
Just on that,
sorry. Charge.
We can only do review for 2 years plus. Yeah, we can't do reviews just for 1 year. So it's got to be minimum 2 years to get a portfolio review. So it's got to be a commitment of 2 years plus. I forgot to mention that earlier. Sorry.
Yeah. No, that's fine. So look, I'm getting some questions actually now, Ed. In fact, the first question has just come from John. He's asking, can you only join for 1 or 2 years, or do you have slightly better discounts? Because he said, I am a long-term investor, and if I'm going to join, I would like to get the best price for a longer-term commitment.
Yeah, look, preferably for brand new members that have never used our service before, 1 year to try us out. That's what most people do. The savvy investors, if you've been in the market for quite some time, they'd usually go for 2 years. They're more confident. But also we've got ex-members on this webinar today, and ex-members have renewed previously. We had a lot come on board in January that were members back in 2015, 2016. For many reasons, they dropped off for many years, but they were all previously on 3, 4, or 5 year subscriptions. So we had a look at that at the time and worked something out. So, but ideally, if you've never used our service before, 1, 2, or 3 years is more than enough, sufficient. And for an ex-member, we may look at longer. That's fine.
Yep, thank you. I've got another comment from Jonathan. He's saying, I used to be an ex-member with you before, and I've actually always enjoyed David Lennox's mining recommendations, and I'm interested in coming back on board. And I do want the portfolio review of my self-managed super fund. So I guess he's got a question about the self-managed super fund. So he's asking, what sort of advice can you provide on a super fund?
Yeah, no personal advice. So we can't tell you how to administer your super fund, but we can discuss equities, stocks. So that's what we provide in the service. So we'll give you our preferred stocks. Our Fat Profits portfolio page lists all of our preferred stocks in the market, and have a current recommendation on that stock and all the history as well. But we will give you a couple of ideas. Look, in the super fund, typically you're supposed to put most of your money in ASX top 200 stocks. The larger funds can stretch it out to 300, top 300 stocks, and also super wrap accounts. These are not self-managed super funds. where you can do your own buying and selling, you've got to stick to ASX top 300 or a stock that's on an approved list. It has to be on an approved list. I have a wrap account, so I can only buy stocks that are on the approved list. Bit frustrating at times, but also more secure because you're only investing in high quality companies and investments. But you can buy some of the smaller mining stocks in the self-managed super fund, so there's no problem there. But we can't tell you how to administer it and how to spread the risk. You've got to do that yourself. We'll definitely give you a hand where we can.
Excellent. All right. We're getting a few more interests coming through. Look, I'm going to close that now. Looks like there's plenty of people interested in premium and platinum. So I can see that there. So look, thank you for your interest so far. I'm going to just move forward with the presentation. We're coming towards the end. Look, for those of you interested in joining our service today, we applaud you for taking the first step in changing your results, because at the end of the day, if you keep doing the same thing over and over again, you are going to get the same results. So we encourage you to take the first step and let us help you over the next couple of years. Now, finally, we do have two stocks to give away today. The first one is Whitehaven Coal. That is a buy recommendation on the back of higher coal prices, which have really helped this company turn around, and their losses that they have been sitting on and now finally turning around into cash. Ed, so just a quick word on Whitehaven Coal.
Yeah, look, if anyone was on this webinar in January would know that we recommended this stock in the low $2. It had come off a sell-off from well over $3 down to about $2.20, $2.30, could have been around $2.40. And we did put buys in our weekly reports for the members, but we also gave it away as a buy back in January on our investor update, one of these webinars, like a few others. that avoid list was also on that webinar as well, and all those stocks have gone down, in some cases 30 or 40% south since that early webinar that we did in early January. So Whitehaven, Angus told members, thermal coal prices are rising. Since then they reported, and they did show some weakness there, but the big number was that they're going to be very profitable and probably pay dividends, and they paid off a lot of their debt during that February report, and we maintained the buy well over $3 currently. So energy prices globally are going up. The profitability of these companies are going to be astronomical. So yes, in the future, coal is going to be something that will be faded out over time, but not straight away. And right now, it's in very high demand. So initial buy at 208, a buy again when it dropped late last year, and then dropped again early this year. You can see that bottoming out in the reddish orange section there in early 2022, and it's been rising since. So it's been very profitable for our members, especially if you bought it at those lower levels.
Yep, excellent. So that's the first one. And the next one, this is for our people joining our service today. This is in the gold mining sector. This is a company which are about to become a producer in Western Australia. They're actually just a couple of months away from producing the first gold. The site is all constructed. You can see it's all set up. They are going to be one of the top 10 gold deposits by reserve in the gold space. You can see the red circle. That's what this mining company is looks like compared to West Gold, which is right next to it. Similar sort of size, a bit smaller than Gold Road and a couple of others, St Barbara and the others included. But this stock is an absolute game changer for our investors. You can see the construction is well underway. They're actually ready to go in the next few months. The power station has been commissioned as well, and all the crushers and everything's been installed. They've had plenty of investor updates. You can see the timeline. They're they're fully funded really. They've got about $77 million in cash at the moment. So all cashed up, fully funded project. The production really starts ramping up in the June quarter of this year. If you look at the gold producers, they have been producing gold in the other mine, and they've been generating some cash from that as well. But this new mine is going to be the game changer. And you can see on the share price chart, that's gone up from 16 cents, which was March last year, when we put a buy on it. Since then, we've had two more buys at 17.5 and 26. It's now at 31 cents, and we do see the volumes really picking up over the last couple of months. Lots of investors getting interested, and we do see this stock going a lot further in the coming 1 to 2 years. So for any new members signing up today, do ask this question and we can give you that stock immediately. Now, finally, if you do have any further questions, you can call us on the 1300 number on your screen. You can also email us at info@fatprofits.com.au. And look, thank you for your company today. We hope you've got some solid information out of today's session. My name is Roger, and if you do have any questions, you can call us or email us, and we'll be happy to help. And I'll pass it on to Edward for his final words.
Yep, absolutely. Look, Roger, we'll try and get to these investors in the next 24 hours to 48 hours. There's a lot there, so I'll do as many as I can. We'll spread the others across to the account management team, and we'll get in touch as quick as we can. A lot of you have asked to make an inquiry to discuss further, so we'll do that. And we'll answer those. Sorry about the questions that we couldn't answer. I've just got the list now. There's quite a few. We could only answer the early ones. So we'll answer those when we make those calls as well. Okay. So thank you very much for joining us today. Happy investing, and we'll, as a member, we'll get you through these volatile times.
Okay. Thanks, everyone. Take care.